Hey guys, in this video, we're going to talk about the straddle. Now, the straddle is only two option legs here, but they're going to be placed at the same exact strike price. Only one leg will be on the put side and one leg is going to be on the call side. So it's going to be the same exact strike price, only one put and one call, and it's going to be in the same expiration cycle as well. So we'll go ahead and create one here. We're in Apple. We're going to be in our June monthlies here. We're going to go ahead and we are going to buy this 125 put here. So we'll go ahead and purchase that. And you can see that's going to cost us around 270-ish to go ahead and buy this. And you can see that obviously we are buying a put, so it is going to be a bearish strategy. And our break even is going to be down here right around 122.30 because that's going to be this 270 is going to be our break even. So we're going to subtract that from our 125 here, and that's going to be our break even. Now, if we're going to create a straddle in which um, we think that Apple will move either up or down pretty big by this expiration. All right. So we think IV is relatively low in here. IV rank is 0. Raw IV is only 25. We think Apple will move up or down pretty well, right? I mean, $4 or $5 expected move. We're at 125 right now. Yeah, we can think it can hit 122, but we also think it can go up by this expiration. So what we'll do is we'll go ahead and we'll purchase this 125 call right here. Now you can see what we did is that we doubled basically our buying power effect and what it cost to place this, because this is going to cost us right around 230 bucks to place. You can see max loss is basically $500. That's what we're paying to place this strategy. And you can see that because we doubled our break even, or because we doubled our price, we doubled our break even. So basically more or less right around $5 it's costing us, or $500 to place this strategy. And you can see that our put break even went from 122.5 to up here to right around 120. And you can see it's on this, it happened on the call side as well. If we were just purchasing this call, our break even would be right around 127.5. But right now, since we are purchasing a debit here on the put side and a debit on the call side, that doubles our cost and doubles our break even to up here right around 130. So now what we need to happen in here is that we need Apple to move outside of 120 or 130 for us to break even or make at least 1 penny on this strategy. Now, if it keeps going, obviously, really it's unlimited technically. Obviously there will be a cap because we don't really know how far Apple can go and how deep in the money this 125 will get, but we do know where our break evens are, and we know we'll be in the green outside of 120 and 130. Now we can go ahead and we can actually do the opposite of this. So where we just created two outside ranges where we want Apple to be in a low IV environment, we can do the same exact thing, only, well, I guess it wouldn't be the same exact thing. It'd be the opposite with a short straddle. So what we would do in here is we would go ahead and we would short the 125 here on the put side. And then we would go to the call side and we would short the 125 as well. So you can see that we're actually receiving a credit for this now. We were receiving right around $500. And that's the most that we can make on this because we can't make more than what we're receiving for something, right? So you can't make more money than what you sold something for. And what we did is we created an inside range here. So rather than Apple having to go outside of 120 for us to make money or outside of 130 for us to make money, we now created that same exact range, only the opposite. So we want Apple to stay inside of 120 or 130 for us to make money on this strategy. So when you're selling these straddles and whenever you're selling anything, you want something with high IV because you want the IV in there to contract and you suck all the premium out of it. And we also have to be aware of what happens in these strategies here. So when you're selling a straddle. So if Apple were to go above 125, obviously you would receive all the credit here on the put because this put would now be expired worthless, but you would have a chance of being assigned here on the 125 call. So that means you'd be purchasing Apple up here and then you'd be buying it back at 125. And on the put side, if Apple were to go down here to 123, obviously your call here that you sold that would expire worthless. So you would receive full profit on that, but you would also have a chance of being assigned here 100 shares at a 125 minus your credit received. So just kind of be aware of that when you're shorting these straddles. But again, that's all a straddle is. Same strike on the put, same strike on the call in the same expiration. And that's all it is, guys. Okay, thanks for watching. Make sure to check us out on social media. We have attached the links to our socials in the description, and we also have a swing trading service if you're interested. There's more information in the description below.